We're going to give people about 30 to 60 seconds to come in. I see we already have 49 participants. Hopefully a few more will come on. So hang in there for about 30 seconds and we'll get started. I think you'll all appreciate this presentation. Okay, why don't we get started? I think you guys will find this presentation very helpful. I see us up to about 55 people and growing. This should be a good relief fund, assuming the process works well. And we brought in Will and I have seen a number of presentations over the last week, and we thought Dean Dorton did the best one, so we got them involved very quickly this weekend, and I think their advice will be good. A couple things I want to just cover right up front. We're really going to focus on PPP, on the Payment Protection Plan program, okay, and how you guys can most efficiently apply for it. I know everyone has questions about the rules for retaining employees who are quarantined, about workers' compensation and other issues. We're fielding those questions. We're trying to get answers for you as best as possible. This is clearly a fluid situation and all those things, so we're just going to try to pump that stuff out to you over the next few days. But let's get focused on getting federal relief for you guys so you can keep paying employees with the federal government's help. Before I throw it to Jen, there's really two things I want to mention. One, time is of the essence. The application is fairly simple, okay? We're going to go over it with you in depth here and get it to a bank as soon as possible. And I'm literally filling out my own application on this call for my own operation and get it to a banker who you know or you have an existing relationship with, a bank, or if you know someone personally, even better. The second thing is there's a very frightening report out of California this morning about an uptick in their workers' compensation costs. I know you each have workers' compensation on your grooms and hot walkers, but from the JICF, from the Jockey Fund's perspective, we have many months of reserves to keep paying our bills. Obviously, we need to figure out how to make up for the loss in income, but we have no plan to do anything like California is doing at this point, okay? The Jockey Fund itself is applying for a loan. We don't know if we'll get it or not, but that was rather shocking information, and we're trying to manage our own situation, but we feel we're in a lot better fiscal position. So having said all that, you don't really want to hear from me. I'm going to bring in Jen Shaw from Dean Dorton, who's going to lead this. I'm going to bring in Jenny first from Dean Dorton, who's just going to explain how this works, and then Jen will get on and walk you through the application process. I hope you're all staying safe and healthy, and let's get some money in the bank.
Good morning, everybody. I just wanted to update you on some housekeeping items for today's presentation. We have muted all participants, so if you have questions throughout the presentation, please use the chat window if you are online, which can be accessed by clicking on the chat icon that looks like a speech bubble located in the bottom menu bar of your screen. If we do not address your question during today's presentation, our contact information is included at the end of the materials, so please do not hesitate to reach out after is needed. We are also recording this webinar today. The recording and related materials will be emailed to you and available on the New York Thoroughbred Horsemen's Association website. So with that, I'll give a brief introduction of our speaker today. Jen Shaw is a CPA at the acclaimed accounting firm Dean Dorton based in Kentucky. Jen currently leads the firm's equine practice. In addition to working exclusively with participants in the equine industry providing tax guidance, Jen helps develop financial and business plans for farms, breeding operations, and racing stables. So with that, Jen, I'll let you take it over from here.
Joe and Will for including me today, and to the attendees for your participation, and quite frankly, the submission of questions yesterday before this webinar. I understand that many of you attended last week's NTRA webinar, where I covered a broad overview of key items in these 3 new laws that may be most impactful to horse and farm owners in general. But today I do plan to just address the topics that should have most impact to New York horse trainers specifically. I will remind the participants that what I say today is based on our current interpretation of these laws, the most significant of which was just passed on March 27th. So I will stress that we do not have all of the answers today, so as further guidance is issued, we will provide updates. In addition, I will remind participants to consult with your advisors about your specific situation prior to making any decisions based on the general advice that I provide during the webinar. Our goal today is to provide you with information on new requirements and potential relief provisions so you may make informed decisions in connection with your advisors as you navigate these challenging times. Here is a listing of topics I plan to cover today. The primary focus of today's discussion, as Joe mentioned, is on the SBA loan programs, the PPP loans, and the EIDL program, some of which is time sensitive. After we walk through these items, I'll briefly cover 2 other programs which help you hold on to cash for longer or receive a credit for retaining employees. Lastly, I'll cover some mandatory sick and family leave requirements for trainers with employees, but also address the corresponding refundable payroll tax credit that should cover such mandatory leave requirements. So let's focus first on, as Joe mentioned, the most time sensitive, the Paycheck Protection Program loans, PPP, or I've adopted this morning P3, I've heard some of the bankers refer to it as. Last week I think I called it PPL, but essentially these P3 loans. This is a completely new program that is governed by the SBA, and it was included in the CARES Act that was just signed into law on March 27th. So again, this is something that did not exist before March 27th. $349 billion was allocated to fund this program, which expands the amount of loan that an employer may receive and also provides for potential tax-free forgiveness of all or a portion of the loan. And so today, I'm really going to focus on, there's 2 key aspects of these loans. Basically the initial, the current priority, how to calculate the amount of this P3 loan for which you're eligible, and then the second aspect would be how to calculate the loan forgiveness. And today, again, I'm going to focus on the how to calculate the amount of loan, because that's really what's all that's necessary for applying for the loan. These are available to trainers with 500 employees or less and who report salary, commissions, and other benefits to employees via W-2s. So if a trainer is only paying independent contractors and reporting those payments on Form 1099s, this P3 loan program is not available. Alternatively, if you have a trainer who is self-employed, that self-employed trainer may also qualify. In addition, independent contractors paid by trainers, so those that receive 1099s from you as trainers, may also be eligible to apply personally for these P3 loans. So again, the focus of my comments today will be on how to calculate the amount of P3 loan that may be available to you. So what are some of the other key components with these P3 loans? There's no personal guarantee and no collateral that are required to obtain these loans. The credit elsewhere provision that is a normal requirement of general SBA loans is waived. So this means when you're evaluating whether or not there's a need for this loan for your business, you're not required to seek other sources of capital, including cash infused into the company by the owner, or obtaining a loan from a different third party. The loan terms, as they were announced and then updated by Treasury after last week's webinar, it's a 2-year term with a 1% interest rate. So that was updated. It was announced originally at 0.5%. It's now a 1% interest rate. There is a deferral of payment for 6 months. So interest does accrue on that 6-month period, but no payments are required to be made for up to 6 months. There is no prepayment penalty if it's paid early. The maximum loan amount, which I'll get to in a second here, is calculated at the lesser of 2.5 times average monthly payroll costs, or $10 million. And one thing that I failed to mention that is on the slide here, the biggest potential benefit under this loan program is that all or a portion of the loan to be forgiven, it can be forgiven if the proceeds are spent on qualifying costs. And so we'll get to that in a second on what qualifying costs are. So again, the loan amount is a lesser of 2.5 times average monthly payroll costs, or $10 million. So what are payroll costs for this particular loan program? Well, payroll costs are gross wages. Again, we're talking about W-2 wages here, limited to $100,000 per employee. The employer cost of group health plans, including insurance premiums, and employer cost of retirement plan benefits. For those who are sole proprietors or independent contractors or self-employed, you're limited to net earnings from self-employment of $100,000 or less. Some additional payroll information here on how for this loan purpose only. The measurement period for most that are completing the application is calendar year 2019. This differed again from what was included in the CARES Act, but Treasury's guidance, along with the application issued, provided for calendar year 2019. If you're a seasonal employer, which is a sort of employment law term, you may elect to use February 15th, 2019 through June 30 of 2019 as your measurement period versus calendar year 2019. If you did not have a business, if you're a new business in 2020, you may use January 1st, 2020 through February 29th, 2020 to calculate this average monthly payroll cost. And then again, for employers, payroll costs paid to W-2 employees are included. Payments to independent contractors reported on Forms 1099 are not included. And I realize there was some conflicting guidance that was, that was included in the CARES Act, and also some guidance issued, from Treasury. But the most recent guidance confirms that in order to participate, you must pay gross wages to W-2 employees. And then on the self-employed independent contractor and sole proprietors, the net self-employment is included. So I wanted to walk through, because we have a calculation that we know how to calculate this loan, I wanted to walk through a few examples that may be common for various trainers, just depending on the structure. So here we have a trainer who does business as an S corporation. And again, a lot of trainers do use S corporations because they help reduce the amount of income subject to self-employment tax. So we have a trainer here with an S corporation that has the following. In 2019, calendar year payments to independent contractors that were reported on Forms 1099 of $200,000. there's no 2019 wages reported on W-2s to either the employees or the trainer. In this situation, because there's nothing reported on a W-2 for 2019, the potential P3 loan is 0, since no wages to employees were paid. In this next situation, we have a trainer, again an S corporation, with the following: 2019 calendar year gross wages and reportable health insurance paid to trainer only and reported on Form W-2 of $60,000. A 2019 calendar year payments to independent contractors are reported on Forms 1099 for $200,000, and then a 2019 net profit reported by the S corporation of $100,000. So the potential P3 loan amount, we add the qualifying payroll, including healthcare costs. So that's $60,000. That's the $50,000 of W-2 wages. It's the $50,000 plus the $10,000 of health insurance, or $60,000 reported on W-2, divided by 12. So that's $5,000 a month times 2.5. So the potential P3 loan in this situation is $12,500. Again, payments to independent contractors reported on Forms 1099 do not count towards payroll costs. And net profits generated by the S corporation are also not included, since it's not self-employment income. Again, a trainer with an S corporation that not only pays themselves, but also has other W-2 employees. So we've got 2019 calendar year gross wages paid to employees and trainer and reported on Forms W-2. That's $500,000, and in this situation, no employee makes over $100,000. Again, we've got $200,000 of payments to independent contractors that are reported on Forms 1099. And the amount of 2019 employer cost of group health insurance is $20,000. So this is pretty common for trainers that do have employees in their operation, as well as paying independent contractors. So here the potential P3 loan would be payroll plus the employer cost of group health. So that's the $500,000 plus the $20,000 of group health insurance, divided by 12, and then times 2.5. So in this situation, $108,333 is the potential P3 loan for this scenario. And again, just a note that we're only including W-2 wages here. This last scenario is a trainer who operates as a single member LLC that's treated as a disregarded entity for income tax purposes. And so if I have a single member LLC and I'm an individual trainer, any net profit from this single member LLC is treated as self-employment income. So in addition to this trainer having net earnings from self-employment, they also have employees. So in this situation, we have a trainer that pays $500,000 to their employees on W-2s, this is reported on W-2s. We've got, again, paying independent contractors of $200,000, group health of $20,000, and they have net self-employment income after all their expenses, so that's their revenue less their expenses, of $250,000. So in this situation, the potential P3 loan amount for this LLC is the W-2 payroll plus employer cost of group health of the $520,000. And then because this is self-employment income, you add the self-employment income, which in this is $250,000, but it's limited to $100,000. And so you get a total of $620,000. You take that $620,000 divided by 12 and then times 2.5. So in this situation, $129,167 is the potential P3 loan. If I have a trainer who is self-employed, so the same example, but there is not, they do not pay wages and they generate net self-employment income, then that net self-employment income qualifies them for the P3 loan. It's just limited to the $100,000. So alternatively, if there was no payroll and employer cost of group health insurance and this trainer was generating self-employment income, and again, this wouldn't be applicable if you are operating in an S corporation because that doesn't generate self-employment income, which you typically don't want because there's more taxes on that. But in this case, you would limit the trainer, even if he or she did not have any W-2 wages, could use that self-employment income up to $100,000 to obtain a P3 loan. On the flip side, let's talk about those independent contractors that are paid by trainers who get 1099s. An independent contractor may separately apply for a P3 loan. So here's an example where we have an independent contractor that's paid by a trainer with the following. Has 2019 Form 1099 income of $50,000 and business expenses in 2019 of $2,000. So the potential P3 loan for this independent contractor is the net self-employment income of $48,000, the 50 less the 2,000, divided by 12 times 2.5. So in this situation, the independent contractor could qualify for up to a $10,000 P3 loan. So we've talked about how the calculation works to calculate what amount of loan you're eligible for. Let's talk a little bit about how to apply. So the applications for the P3 program will be handled through the SBA approved banks versus SBA directly. And you can go on SBA.gov and search by zip code in order to determine which banks are currently SBA approved. There was an updated application that was released on April the 3rd along with some FAQs. And so if you've not already done so and believe you may qualify, I would recommend you contact your bank. Businesses and sole proprietors were eligible to begin applying for these loans on April the 3rd, and independent contractors and self-employed individuals may apply beginning April the 10th. Each bank has its own process for accepting these applications, including what information is needed. So, technically banks were eligible to start this loan application process last Friday. Some were more successful than others. In order to start this, they had to be SBA approved. If your bank is not SBA approved, they had to file an application with the SBA. So I'll talk a little bit about timing here in just a little bit, but it does really vary by institution. So you must apply and have your application processed by June 30th of 2020, but because initial funding is capped, again, the initial funding is $349 billion that was allocated by the CARES Act. It's recommended to apply as soon as possible. It's sort of a first come, first serve. And I know there's been some discussion between Treasury and banks that if the funding runs out, then there could be additional funding requested, but I believe that would have to be done through legislative action. And so really it's sort of a first come, first serve as it relates to the initial funding. The updated application was released on April the 2nd by Treasury. We're going to walk through it here in a second. And then if there's any additional information that you're looking for regarding this application, it's available at treasury.gov/cares. But let's look at this loan application. And I realize it's a little bit hard to see on the slide, but this is what your bank, either electronically or via paper, what you'll be required to complete as you walk through this application. So at the top, there's a box that says check 1, and it lists sole proprietor, partnership, a couple of different corporate entities, LLC, independent contractor, and eligible self-employed individual. You may meet more than one of those criteria, but you're only supposed to and required to check 1. The other items are pretty self-explanatory as far as legal name, address, EIN or Social Security number, and the contact information. The average monthly payroll, as I mentioned before, is typically based on calendar year 2019 for most. But if you're seasonal, you can do February 15, 2019 to June 30, 2019. And the calculations that I went through for those various scenarios before really just, that's what you would put here. So that average monthly payroll that we calculated under those various scenarios, you'd put that number there times the 2.5 and to get to the number. And we'll get to the EIDL portion here in a second. The number of employees, we've been getting a lot of questions about this. This is not defined in the application process. And so we think it might be used for the SBA's statistical reporting. So we've recommended either use the average monthly for calendar year 2019 for the same period that you're calculating your potential loan amount, or use your average number of employees as of sometime in 2020. The purpose of the loan, this is where you have to let the SBA or the bank, because the bank again is processing this, know what you'll be using these loan proceeds for. Combination of payroll, lease or mortgage interest, or utilities. And that, again, that's just sort of what you plan to utilize it for. So if you only have payroll and not mortgage interest or lease and utilities, you would just check payroll. The ownership is required to be disclosed for all owners with an interest of 20% or more, and you can attach a separate sheet. But for any owner in a business, you have to, if you own 20% or more, you have to provide that information. The next few sections here walk through questions, and specifically these questions are designed to kick non-qualifying applicants out of the loan process, so that they can pretty much the bank pretty much knows to deny any application here. So the first one deals with bankruptcy. And so if 1 or 2 are below are answered yes, then your loan will, you don't even need to apply, because that you'll be kicked out. So again, if someone is presently involved in bankruptcy, or the applicant has defaulted in the last 7 years on a loan from the SBA or other federal agency. So if you can't check no to those, then you're not qualified to participate in this program. Question number 3 is the applicant or any owner of the applicant an owner of any other business or have common management with any other business. So this is where we have to look at and disclose the amount or the relationships with other businesses. So if you're a person that owns multiple business entities, you'd be required here to attach a listing of and describe the relationship of what % ownership you own in those businesses. And this gets back to just trying to make sure that you qualify. Number 4 here, has the applicant received an SBA economic injury disaster loan between January 31st, 2020 and April 3rd, 2020? So if yes, you're required to provide details. And I've had some questions on this, can I apply for both? And the short answer is yes, and we'll talk a little bit about how you can apply for both the P3 loans that I'm talking about now, and then the EIDL loans that I'll talk about here in a few minutes. But again, all this requires is that if you've received an SBA, the EIDL loan before April 3rd, basically the beginning of 2020, you're required to disclose that here. Not necessarily, so if you're going to apply for an EIDL loan, which again I'll talk about in a second here, concurrently with this P3 loan, that's not required to be disclosed here. All right, and the questions continue, and so it talks about number 5 is the applicant, so that's the business, or the self-employed individual, or any owner that owns 20% or more, subject to an indictment, criminal information arraignment, or other means by which formal criminal charges are brought, or presently incarcerated or on probation. Again, if that's applicable, then you're not eligible for this program. And then also along those lines, within the last 5 years, for any felony, has the business, the individual or any owner of the business been convicted, pled guilty, been placed on pretrial diversion, or been placed on any other form of parole or probation? If you answer yes there, the loan will not be approved. The next question we've been getting some questions on is the United States the principal place of residence for all employees of the applicant included in the applicant's payroll calculation above. And this, there's an exemption for paying employees outside of the U.S. So if you are paying wages to an employee that's not in the U.S. or who is not in the U.S., those wages do not qualify to be counted in the monthly payroll calculation. So we've had some questions here about H-2B, H-2A employees, and if you are paying them for work, which you would be here in the U.S., those wages count, and so you can check the yes box here, because you're only paying those H-2A and H-2B employees for work that they are doing here in the U.S. So that's a little bit of a confusing question, but the idea behind that was that you're only counting wages for work done in the U.S. in this calculation. And I'll skip question number 8 because that's not applicable. That's really for another industry. The business that is applying for these P3 loans, certain certifications have to be made by the business. And so one of the biggest certifications that has to be made is the uncertainty of current economic conditions makes the loan necessary to support ongoing operations. Other certifications, funds will be used to retain workers and maintain payroll or make mortgage payments, lease payments, and utility payments. The business does not have an application pending for a loan for the same purpose and duplicative of amounts applied for under this program. And you will document and provide this documentation to the lender regarding these qualified expenditures for the 8-week period. I will note about the first certification, and it really implies that you may not have yet suffered a loss, but given the uncertainty of economic conditions, for example, with canceled or postponed races, future operations may be impacted by these items. So it was intentionally made to be broad versus sort of more stringent than the normal SBA provisions. So I do want to stress that the bank that is accepting the application will be the final decision maker when approving or denying the loan. So it's important to discuss any calculation questions or disclose positions taken when filing the application. And I know last week, as everyone was trying to figure out these calculations, there was a lot of back and forth with the bank telling you to talk to your CPA, with your CPA telling you to talk to the bank, and eventually, it generally required a conversation with the CPA, the banker, and the client on the phone to figure out what would be accepted. So, but again, the bank is the ultimate decision maker here because they're the ones that decide whether to accept or deny the application. So just a couple of questions that were submitted, that were pre-submitted, that I just wanted to make sure I tried to cover a little bit, but I want to specifically address. Is training considered gambling income? So gambling income is still not eligible for these P3 loans, and that was at least as of today. And so training is not gambling income. So training is treated separately. It's under a separate code. So if you are a trainer with employees, with W-2 employees, you potentially qualify for this P3 loan program. My payroll is higher than 2019. Can I apply for a larger amount? No, unfortunately, the P3 loan is based on the 2019 payroll that I discussed for most. I mentioned H2B or H2A wages included in the payroll number, and again, since they're in their W-2 income, there's an exemption for wages paid to employees while outside of the U.S. So since these wages are for work performed in the U.S., they should be included. Here. What if my bank is not an SBA-approved lender? Well, go to SBA.gov to find one. There may be a delay, as many banks have said, for example, that you had to have a bank account by a certain date in order for them to start processing these loan applications. But stay tuned, because I think that as banks get the first wave, if you don't have a current bank account with an eligible bank, perhaps these current SBA approved lenders will open up that process, or your bank could also potentially apply to be an SBA approved lender. And then how long does this process take once I apply? It varies widely. We've had some smaller banks that have processed applications last Friday and have told clients they'll see the funds in as early as 2 weeks. For others, some banks are still not yet accepting applications. So talk to your bank or banker about this, because it really does vary widely. The biggest benefit to these P3 loans is the potential for tax-free forgiveness for all or some of this loan. So, and not only just to be forgiven, but also to be tax-free. So here's an example. So if I incur $10,000 of W-2 wage expense and I receive a $10,000 P3 loan to fund it, if this $10,000 loan is forgiven, I may still deduct the $10,000 of wage expense, but I don't have to include the $10,000 in income. And the forgiveness amount should include the accrued interest over the life of the loan and not just the principal. So it's based on the forgiveness amount is based on the use of funds and the employee retention, and is available for up to 8 weeks of qualifying costs paid for payroll, mortgage interest, or rent and utilities. And the 8-week period begins when the loan proceeds are received. And I've listed them here. So payroll costs, as defined earlier for eligibility, but with some key differences. Interest on mortgages and rent, and that mortgage interest or rent is based on agreements that were in effect as of February 15th of 2020. Utilities, including phone or internet and other standard utilities like electricity, gas, and water. And then Treasury announced in guidance issued last week that qualifying non-payroll costs such as rent, mortgage interest, or utilities, which exceed over 25% of the loan total, will not be forgiven. The amount forgiven will also be reduced for a reduction in employees if that reduction is not covered by the end of the 8-week period. And there's also currently a gap between the amount of payroll eligible for the loan, as we discussed, versus what is currently eligible for forgiveness based on the CARES Act and Treasury guidance. So unless there are some updates, some payroll costs, employee FICA, and federal income tax withholding may not be forgiven. And I haven't gone through that calculation yet here, because I think there's going to be some updates to the language that may fix some of that. So the ability to have at least a portion of the loan amount forgiven and the relaxing of some of the normal SBA qualifications for loans make this P3 loan program attractive to those who qualify. Since this is a function of wages paid and/or self-employment income, it's only available to trainers who have employees or trainers who are self-employed. So the other SBA loan program that I'll talk about is the Economic Injury Disaster Loan. And I'll refer to it today as the EIDL. So those trainers who may be eligible for these loans include those with and without employees. So for those of you that don't pay employees via W-2 wages, but pay your contractors via 1099s, this could be a loan program for you. In order to be, for business to qualify, there are a little bit more restrictive terms here. It must be deemed a small business, and that includes trainers with less than $12 million in average annual revenue. And that's calculated as the total revenue over the latest completed 3 years divided by 3. I will mention for these EIDL loans only, farms are not currently eligible for these loans, and also gambling entities. Farming only applies to those whose primary activity is breeding horses. Training is not considered farming. So if you are a trainer, with or without employees, you should be eligible for this EIDL program. If you are primarily a breeder who breeds horses, you're not eligible currently for EIDL, but you are eligible for P3 loans. I just want to make that point clear that training should qualify for both of these programs. And these, when you're looking at gross receipts, you want to make sure you include affiliates, which is basically looking at, do you control other entities, and in total, do those entities exceed this gross revenue threshold? There's also a certification required on the P3 loan application that you've looked at these attribution rules in order to evaluate. These loans have been in existence for some time to address disasters, but the recent law increased funding due to the COVID-19 pandemic. So these laws are governed by the SBA regulations, which are completely separate from the past law. These loan proceeds may be used to repay obligations that cannot be met due to revenue losses, such as paying accounts payable, like training and board or staffing costs for care of the horses, funding payroll, payment of fixed debts and monthly mortgage payments, or short-term notes that may be paid along with lines of credit. They cannot be used to refinance long-term debt, and they cannot be used to replace lost sales or profit or for expansion. The amount that's loaned depends on the need. In other words, what working capital losses have you suffered due to the COVID-19 disaster? The loans cannot exceed $2 million. And note that the SBA determines the amount of the loan and the repayment term. So I don't have an example in the materials of the amount of potential EIDL loan, because this is determined on a case-by-case basis with the SBA, or by the SBA. The interest rate is 3.75% for small businesses, and it can be for a long-term for up to 30 years. So in general, if an owner of a business owns 20% or more, then the owner is generally required to personally guarantee the loan. However, the CARES Act only requires a personal guarantee if the loan amount exceeds $200,000. Collateral is also required for all loans over $25,000, and that's typically sought from the 20% or more owners. And collateral includes things like mortgage or real estate lien, or a security interest in personal or business property, or either of the above. And I've gotten some questions about what constitutes collateral here. The SBA will have to answer that as it relates to what they will accept, whether horses specifically could be collateral for them. And in general, these EIDL loans require that the borrower attempt to obtain credit elsewhere, but this was waived as part of the CARES Act. However, the borrower must demonstrate that they have the ability to repay or accept or have acceptable credit. For these versus the P3 loans that go through the bank, you apply directly online with the SBA here for these loans. Of particular note, this EIDL program permits eligible borrowers to apply for a $10,000 emergency grant advance, which will be paid within 3 days of an application being accepted. this loan amount or advance does not have to be repaid, unlike the remainder of the EIDL loan. So this may help cash flow in the short term, but also does not require the $10,000 to be repaid. So here's an example, this $10,000 advance. If I incur $10,000 of staffing expense and I receive a $10,000 EIDL advance grant, a fund, that $10,000 offsets the $10,000 expenditure. So this is a net zero to the bottom line for income tax reporting. I have $10,000 of grant income and I have $10,000 of staffing expense, so it's a net zero. The EIDL application is, again, at sba.gov, and there are links to COVID-19 related relief along with the EIDL application. You'll need to provide gross revenues and operating expenses for the 12-month period prior to January 31st, 2020. Additional information, so I've tried to capture just a little bit of a screenshot of part of the application, and then also I've attached, in general, what most SBA loans require or request when obtaining an SBA loan. So the P3 loan requires less financial information be provided, and certainly no financial information be provided by the owners of the companies. For the EIDL program, there'll be a little bit more looking that the SBA does, not only at the financials for the company, but also the financials of the owners who have 20% or greater interest in the entity. And so things that might be provided could include tax returns, current financials for the business, and personal financial statements for each 20% or more owner. And I've gotten some questions of if you don't currently have if you haven't completed your 2019 tax returns, what can you use? And I've seen some commentary out there that the SBA may allow a 2019 financial statement versus if you haven't completed your 2019 tax return at this point. So just a few questions on these EIDL versus P3 loans from the questions submitted. So which is a better loan program for the trainers, the P3 or the EIDL? Well, in general, I would say the P3 because of the loan forgiveness potential. If you're paying your employees via W-2 wages, that's probably more beneficial because of the forgiveness. The EIDL would be more beneficial for those trainers, or would be the only program that trainers that pay contract labor via 1099s could utilize. If I've already applied for an EIDL, can I turn that down and get a PPP or P3 loan instead? You can actually roll that over into a P3 loan. And then the next question, can I apply for both the P3 loans and the EIDL program? Yes, as long as it's not used for duplicative purposes. So I can, if I'm a trainer with employees, I can apply for the P3 loan to cover my payroll costs, my rent, and my utilities. But then I can also separately apply for an EIDL loan to cover, other costs that are not qualifying for under the P3 loans. If someone with a few W-2 employees is still able to collect revenue and pay staff, are they eligible for any of these programs? Well, for P3 loans, you do not necessarily need to demonstrate that you've suffered a current economic loss, just that the current economic uncertainty makes the loan necessary to support ongoing operations. And again, the language in the CARES Act is intentionally broad here to allow more businesses who think that even though they may not have been impacted currently, but may be impacted to apply. So again, those are the two big programs that fall under the SBA loan programs. The first one being more time sensitive because it's got a funding cap, and then the second one also being available to those with or without employees. So I want to shift a little bit and talk about some other employer-related relief. And again, this is just applicable for trainers with W-2 employees or self-employed trainers. And this first provision is really just focuses on a deferral. So it either So employers and self-employed individuals may delay payment of the employer portion of Social Security tax, the 6.2% that was incurred from March 27 through December 31st, 2020. Again, this tax liability must be paid. It's just deferred, it's not forgiven. It must be paid in 2 installments, 50% of this due by 12/31 of 2021, and the remaining 50% by 12/31 of 2022. Again, even though it needs to still be paid, it's a way to keep cash longer. But this is not a forgiveness. This is something that will eventually be payable. And then I will mention that employers who receive loan forgiveness via the P3 program are not eligible to do this deferral. Another program that's available to trainers with W-2 employees or self-employed trainers is the Employee Retention Tax Credit. This is available for employers who are either required to fully or partially suspend operations due to COVID-19 related orders from the appropriate governmental authority, or who have gross receipts of 50% less than gross receipts in the same quarter as the prior year. It's a refundable payroll tax credit computed as 50% of wages paid for the period March 13 through December 31, 2020. And so up to $10,000 in wages per employee per year could be counted in calculating the credit amount, and health plan expenses could be treated as wages when computing the credit. So this overall credit is limited to $5,000 per employee for the year for those employees which earn at least $100,000. And again, this is for W-2 employees only. If you have less than 100 employees, then all of your employee wages are credit eligible. And you, again, meet the criteria if you're operating in business and your operations were either fully or partially suspended, or if you look at your gross receipts from this calendar quarter, and they're less than 50% from the prior year's same calendar quarter. It does not, qualified wages for this purpose does not include the mandatory sick and family leave paid to employees that I'll talk about here next. And again, if you have 100 employees or less, all of those employees are eligible to be counted towards this credit. So for those with employees, oftentimes we're doing calculations between what is most beneficial, the potential loan forgiveness under the P3 loan program, or this employee retention tax credit. And again, you can't do both here. It's one or the other. If you get a P3 loan forgiven or participate in P3, you're not eligible for this employee retention tax credit. And just one last point on that last item there. This could apply to trainers who have lost or have seen significant reduction in income potential due to reduced or canceled racing, for example. And as a reminder, it only applies to those with employees, but the credit is a permanent reduction of cash outlay. It's not required to be paid back. All right, the last thing I'll cover very briefly is the mandatory sick and family leave payroll tax credits, and also the leave that's required. So for those with employees, there's a new requirement for employers with less than 500 employees to provide sick and family leave time to employees who meet certain criteria for leave related to COVID-19. This is effective beginning April 1st through December 31st, 2020. So this applies to trainers with less than 500 employees. And it requires employer to provide 2 weeks up to 80 hours of paid sick leave if the employee is unable to work for COVID-19 related reasons. And part-time employees may also qualify for this. You look at their leave based on the average number of work hours in a 2-week period. I want to stress that those that are subject to this requirement, it is an outlay of cash, but there is a corresponding credit that should cover 100% of this cost to the employer. So for all employees, 2 weeks of up to 80 hours of paid sick leave at the employee's regular rate of pay where the employee is unable to work because the employee is subject to a federal, state, or local quarantine or isolation order related to COVID-19, or has been advised by a healthcare provider to self-quarantine due to COVID-19, or is experiencing COVID-19 symptoms and is seeking a medical diagnosis. This is limited to $511 per day and $5,110 in total over the 2-week period per employee. Or, again, for all employees, 2 weeks of up to 80 hours of paid sick leave at 2/3 the employee's regular rate of pay because the employee is unable to work due to caring for an individual subject to these same COVID-19 items as previously mentioned, or is caring for a child whose school or place of care is closed for reasons related to COVID-19. This amount is limited to $200 per day and $2,000 in total per employee over the 2-week period. And I've included a chart here that summarizes what paid sick leave is required to be paid. And in addition, employees who have been employed for at least 30 days are entitled to an additional 10 weeks of paid expanded family and medical leave at 2/3 the employee's regular rate of pay when an employee is caring for a child whose school or place of care is closed for reasons related to COVID-19. That's limited to $200 per day and $10,000 per employee. So an employee who has been employed at least 30 days and is taking care of a child whose school or place of care is closed due to COVID-19 may qualify for up to 12 weeks of leave, 2 weeks sick, and 10 weeks of family leave, and a total of $12,000. There is an exemption available for businesses with fewer than 50 employees, but that exemption only applies to the requirement to pay sick and family leave related to school closings or child care unavailability. So if you have a person, an employee who is subject to a COVID-19 isolation or quarantine order, this exemption does not apply. However, on the flip side, the IRS provides refundable payroll tax credits that are equal to 100% of these required sick leave that's required to be paid to your employees. So the goal of this program is to reimburse employers for the cost of these paid leave programs quickly so that these credits are refundable payroll tax credits versus an income tax credit. In addition, the IRS last week announced or released Form 7200, which you can use to request an advance payment of the refundable payroll tax credits for these leave programs, along with the employee retention credit that I discussed earlier. So again, the whole idea is that the net cash outlay for these mandatory leave programs is zero, and you are eligible to file a 7200 in advance to request payments or refunds from the IRS to fund these programs. So just a couple of closing remarks here, or a few closing remarks. Again, I want to stress, please work with your bank, with your advisors on your specific situation. I tried to include some examples of how to calculate the potential loan amount under the P3 loans, but just in general, trainers with W-2 employees or trainers who generate both self-employment income may be eligible for both the P3 and the EIDL loans, and if you do not participate in the P3 loan program, then consider the deferral of employer Social Security taxes or the employee retention credit. Trainers with no W-2 employees, and those would be trainers that operate as S corporations, you may be eligible for the EIDL program. And then also independent contractors who may receive Form 1099 payments from trainers may be eligible for these P3 loans. So again, I know we covered a lot. We're right at 12:30. Will, I don't know if you want to say a few words, or Joe, or.
I do. Thank you, Jen, so much. There were a couple additional brief questions, if I can ask those. I know we're running short of time.
Sure.
What business category should training be listed under for EIDL purposes? Do you know that offhand, or can you let me know and then I can message it out?
Yeah, so I mean, I looked at that yesterday, and there's no, I mean, there's a lot of them are pretty general categories. So I would say something services related, and just put other, or other not included. So because there wasn't anything that was trainer specific.
Okay, thank you. On the P3 application, there's a question about, there's a question regarding question 3. I don't know if you can pull that slide up on short notice, but ownership is defined as question mark, shareholder in a corp question mark, limited partner in an LLC question mark. Need to be listed even if all are less than 20% ownership.
That is a good question. I think for this seems to indicate that it would just be for entities of which you own 20% or more, but I don't know.
Would this be one of the items that might have further clarity either today or tomorrow, as you know, the rush to get something out? This may have been something overlooked, or?
Yeah, and what I would say is we've had lots of clients get their legal counsel involved to do the attribution, to look at the attribution rules and to look at the org charts. So I don't know that I can comment on a specific time frame with regards to any updates there.
Okay, thank you. You did cover this earlier. I just didn't have it available to me to answer the question. I believe this is with regards to P3 loans as well. What if you have started up this year, do you not qualify for any help? I believe you can use a January, February period as an alternative to 2019. Is that correct?
Correct. So there's a, and in the materials here, there is, let's see here, I want to make sure I give the correct time frame. Yep, if you're new in 2020, you can use your payroll for January 1, 2020 through February 29, 2020 to calculate.
Awesome, thank you. This question is a little broad, and it was just emailed to me, but thankfully I had it open. I am running a couple of racing partnerships. I do not take a salary. As you can imagine, while our horses are not running, we are paying training expenses to keep them in shape, but no way to make any purse money. Is there any part of the new stimulus bill that could apply to us? Of course, you know, the focus of this was training, but didn't know if you could answer that quick question about partnerships.
Yeah, absolutely. We've gotten a lot of those questions as it relates to partnerships, and we've recommended that partnerships pursue the EIDL program and submit the financial information to the SBA to see if they qualify for some relief as it relates to those, obviously the training and the board bills that continue.
Okay, thank you. And then we have gotten a couple questions, specifically not trying to single out any banks, but things like locally or maybe nationally, Chase has been problematic. Is there any basic guidance you think that you could give our membership if they have a relationship with Chase? You know, I think I would be inclined to tell them to try again, because I think having a personal relationship with a banker or a bank is helpful. But at what point do you maybe pull the plug and then just start calling banks randomly because you don't want to miss out on this loan, like it might get fully subscribed?
So that's a great question, and what I would say is that it's best to first go through the bank with whom you have a existing relationship, because most banks are so overwhelmed and inundated with these application forms that unless you had a relationship with them before this process opened up, they're really too busy handling current customers. And what I can say on Chase specifically is it's my understanding that they started processing these loans over the weekend and through today. So I think if you originally talked to Chase and they weren't processing them, I would go back and ask them to confirm or see what the next steps are to get your loan in the queue.
Okay, thank you. It's 12:35. So I think we've gone over by a little bit. I really do appreciate you taking the time, Jen. I thank the participants. I thank everyone who asked questions in advance and in this Q&A box. I also thank the NTRA for connecting us, Jen. You know, I found out about your presentation last week on their microsite. It's pretty comprehensive. It's very comprehensive, and I'm using it myself. I encourage all of our membership to check out the NTRA COVID-19 microsite, and we'll continue to message via email and text to our membership. It's clear that these programs have great terms, so I encourage everyone to go and get the money, get their fair share. And this presentation, once again, will be posted on NYTHA.com. We'll email membership and let them know. And you know, my last comment is, you know, this is a very fluid process. Joe mentioned it, you mentioned it. If there are any changes, we will keep people informed. And lastly, please stay safe and healthy. We're in this for the long haul. Thank you so much.